Hey, my name is Spencer Carenti. I run Alkaline Advisors, and today we will be reviewing the fundamentals of commercial real estate underwriting. So before we begin, I just want to give a quick shout out to the folks at AZ Educate. Really appreciate them allowing us to help educate the next generation of real estate leaders. If you're here watching this video through AZ Educate, that's amazing. Keep it up. You're on the right path. And if you're here on your own, welcome. Hopefully, everyone here walks away having a little more insight into the world of real estate underwriting and analysis. So, to begin, I just want to give a brief overview of what I do. I started this company, Alkaline Advisors, in 2020, and we are real estate analysts. We are in over 30 states across the US, and we'll work on all property types. Specifically, our focus is on building financial models and underwriting for different players in the real estate industry, whether it's a developer or a lender or a broker. Our goal is to analyze deals, and we've analyzed a ton of deals. Last year, we analyzed over $4.5 billion worth of real estate. And what we've realized is no two underwritings are the same. What we've also realized is a lot of people will overcomplicate the principles behind financial modeling and underwriting. So after working with hundreds of groups, what we've decided is how do we create an overview of the real estate analysis and underwriting space and make it as easy and simple as possible for folks who might be a little newer in the industry so that they can understand the basics. And that's what we've attempted to do here. Hopefully you guys find it helpful. And with that, I'll dive in. So what we're going to do is we're going to start from left to right on the bottom in terms of the tabs. This is the cover tab. You'll see we've outlined all the tabs to the right over here. And by clicking on each link, it'll take you directly to its corresponding tab. So throughout this program, we're going to go tab by tab from the top to the bottom, and we're going to outline the basics of real estate underwriting and analysis. So let's start on tab number 2, CRE overview. I always say that there are only 3 variables at its core for real estate underwriting and analysis. Those variables are contributions, distributions, and timing. Contributions are what are you spending? Distributions are what are you receiving, and timing is when does that all happen? If you have information on those 3 variables, you're good. You can create a financial model. Now, it might not be a very detailed model, but it is the core principle behind understanding a real estate property's financials. So you'll also notice, let me zoom in a little bit. You're going to see these plus signs. If you click the plus sign, you're going to see more information underneath that plus sign. As we work through the document, just so that it's a little less confusing and not as much to take in as at once, we've compartmentalized these different sections. So now let's get to types of models. We're going to be covering 2 types of models in this video. The first is going to be a static model, and the second is going to be a dynamic model. A static model has 2 variables. The first is contributions and the second is distributions. So before we even load in the information over here, notice that there are blue cells. In these blue cells, those are going to be the only cells that you plug information into. So if we type in A, enter, it says awesome, right? Great. That means all you have to do is plug information into the blue cells. Try not to touch any of the other cells. So in this static model example, you'll see we have dollars out and dollars in gives us the profit. So if we say we have $110 out and we're getting back $180, that means our profit is $70. But what the static model fails to show us is the time value of money. So that is why oftentimes we will analyze more thoroughly with dynamic models. As you can see, in this dynamic model, here, let's go back to that first example of spending $100. In this dynamic model, we're also spending $100 and we're also receiving $180. But now we are aware that this is over a 3-year period. We're spending $100 in year 0. We're receiving $20 in year 1, $20 in year 2, and then $140 in year 3. And when you sum all that up, we're back at $80 total. So you'll see they equal each other. So we're going to briefly review in this Excel document the fundamentals behind a static model, and that's going to be this yellow tab. And then a majority of our overview is going to be digging into the dynamic model overview. So before we get into the models in more depth, we're going to be reviewing the underwriting as it relates to a multifamily property. And a multifamily property, synonym for that is an apartment building. Think of that as a building where people are renting, right? If you're renting a unit, you could be one renter of one unit, and it could be a 100-unit building. So there are 100 renters in that building. Other types of real estate, which we won't be analyzing, but I would say are part of the key food groups of the industry, are retail, office, and industrial. Those three use longer term leases, and you, as a, let's say, real estate owner, are leasing out to a business. And then we have a hotel, also known as hospitality. So where multifamily is analyzed with monthly rents, hospitality is analyzed with average daily rates, ADR. And the way you can think of this is if you're renting an apartment, typically you'll spend thousands of dollars a month on rent. But if you're going to book a stay at a hotel, you're looking at it on a nightly basis. So that's how you're going to typically set up these underwriting systems when you're analyzing these different properties. And again, we're going to be reviewing the multifamily section. And then we want to review 4 key players in the real estate industry. Now, there are more than these 4, but in this analysis, we'll review these 4. So to start, you have investors, and the investors are the general partner and the limited partner. General partner is GP, limited partner is LP. These two make up the equity of a project. Now, the lenders make up the debt of a project. And between the debt and the equity, that is what you call the sources of capital. We'll dive into the sources later, but the general partner is typically more involved in the transaction. They are what we call the operating partner, and a lot of times they're the ones that are doing all of the work. The limited partner, primarily, they are bringing forth a majority of the equity to the investor pool, and they are what we call silent partners. The lenders, they could also be private investors. They could be life companies. They could be REITs. There's a number of different types of lenders in the real estate field, but they are providing the debt. And then finally, we have brokers. So brokers, in my opinion, make the industry go round. There are different types of brokers. They have what we call investment sales brokers. So brokers that are helping groups sell buildings or helping groups buy buildings. We have capital brokers. So brokers that are facilitating the transactions between lenders and investors, or between the GP and the LP, so between the equity. And there are also leasing brokers. So some brokers help lease out units at a multifamily level. Some brokers help lease out tenants if it's retail or industrial or office. So these are the key players in the real estate space. So the next tab we're going to go to is the static model overview. So some of the topics we're going to review are the revenue calculations, very broadly speaking, the expense ratios, and what a cap rate is. So when we talk about a static overview, a lot of times you might also hear this being called a back of the envelope analysis. Why? Because it's very simple and straightforward and can be done on the back of an envelope. So in terms of project costs, we are going to get very high level. We're going to say this project we're analyzing is going to cost $10 million to build. Now we're going to focus on operations. The operations at its core, revenues minus expenses equals net operating income. So to calculate the revenues, what we're going to do is say we have 50 units and each unit is going to be rented at $2,000 per unit per month. And when you calculate that there are 12 months in a year, we are then saying that there are $1.2 million of revenue every year coming in through this project. For expenses, we can calculate expenses in a number of ways, but here we are just going to say the expenses are a percentage of the revenue. So you'll notice if it's 30% of the revenue, we have a lesser expense ratio, meaning that we have more net operating income at the end of the day. And if it's a higher expense ratio, there's less NOI or net operating income at the end of the day. Let's make this 30% for now. And then finally, we're going to derive the value of the asset. And to do so, we're going to talk about the capitalization rate or the cap rate. The cap rate is just the potential rate of return. So you're going to hear this phrase a lot, and it's very simple. What you do is to calculate the value of a property, you are going to take the net operating income and divide it by a projected cap rate. And that is going to give you the value of the asset. And essentially, it's going to say this property spits out NOI of this amount, which is annually X% of the value of the asset. And what you'll notice is when you're analyzing deals, the higher the cap rate, the higher the proportion of NOI related to the value of the property. The higher the cap rate, the higher the perceived risk of the project. So what does that mean? We'll show you right here. If we say that there is a 10 cap, you'll notice that the value of the asset decreases, because what we're saying is you are receiving 10% of the value a year in NOI, which typically the more money you're receiving on an annual basis as it relates to the value of the asset, the riskier that asset will be. If we have a lower cap rate of 2%, you'll notice the value of the asset is significantly higher, because we're saying that folks would be willing to spend more money and collect a smaller coupon as it relates to the value of the asset on an annual level, because it is a safer investment. So the higher the perceived risk, the higher the cap rate, and the lower the property value is compared to the net operating income. So in order to calculate now the profit of the property, we'll take the project costs being 10 million. We'll take the net operating income. So this is just in 1 year, it's spitting out $840,000. That's revenues minus expenses, and that's $840,000. And then we're going to add in the sale price. In this scenario, you'll notice at a 10 cap, given this NOI, we're selling it for 8.4 million, but we paid 10 million. If we make this a 5 cap, we're selling it for 16.8 million and we still paid 10 million. So let's make this a 5 cap. We're saying we paid 10 million. In 1 year, we're making 840,000 of NOI, and we are selling the project for 16.8 million. So our total profit is 7.6 million. Now, again, with this static model, we aren't seeing the duration of the hold period, and we're also being very basic with our inputs and assumptions. If we wanted to be a little more granular, and if we had maybe more inputs or more variables that we could use to help us more specifically calculate these outputs, we would then turn to a dynamic model. And that's what we're going to review next. Before we get into the dynamic model overview, I want you to look at this chart right here. What we've done is we've broken out a complex dynamic model into 6 distinct segments, which we will review on their own in each of the tabs. Project costs, operating statement, capital stack, debt service, sale value, and return metrics. Now, after you review all of the individual tabs, we're then going to go to this dynamic model template tab. That tab will allow you to put data and inputs directly into the model and see how different variables impact different return metrics. We'll dive into that a little further. Before getting there, I want to just show you what this tab encapsulates. You'll see it has a project cost section. This is what it looks like. It has an operating statement section. We have revenues, we have expenses, and then we have net operating income. And you'll see it's a little more detailed than the static model. You'll also see we don't just have total costs, but we have timing as well. Next, we have the capital stack section. The capital stack for this example, we're going to be breaking out into equity and debt. The equity is going to be broken out further into GP equity and LP equity. Remember the players from the CRE overview tab. And also debt would be the lender. Next, we'll be talking about debt service or interest. So in that static model example, that is what we called an unlevered project. Unlevered is just a fancy way of saying no debt. When a project does have debt, we say that it is levered. So in this example, we are reviewing a levered project. This is a multifamily development underwriting pro forma. So underneath the debt service section, we have sale value. And underneath sale value, we have the return metrics. The return metrics, we will showcase the returns at a project level without debt, right? Net unlevered cash flow. We will showcase the returns at a project level with debt. That's net levered cash flow. And then we will take this line item, that net levered cash flow. We will say, how does this line then be distributed to the equity partners, the GP and the LP? And we will go through that as well. So if we scroll up, this is what the entire dynamic model that we will be reviewing looks like. So to start, we will be reviewing the project cost section. So in this section, we will review the costs and when they're incurred and why they're incurred at different times. And then we'll also be reviewing deal progression. So you'll see here the construction costs are broken out into 3 segments. We have land acquisition costs, we have soft costs, and then we have hard costs. And when you add all of those costs up, we have the total costs to build this multifamily project. Now, these are just sample costs. You can have hundreds of costs at each level of development. Typically, when you're analyzing a model, these different costs happen at different times. You'll start with the land costs, the acquisition costs, then you'll have soft costs, and then you'll have hard costs. So here, we'll say that the land costs start with $6 million for acquisition, $40,000 for closing costs, and $25,000 for legal costs. Now, you might incur all these costs at the same time, or you might incur them over different times. The point of building out a pro forma is for us to get a better sense of when do we anticipate these costs incurring so that we can figure out when do we have to bring money to the table to cover these costs and how much money do we have to bring to the table because we want to know how many costs are we going to have. So when we're reviewing these costs, we can say they all happen in 1 month and they end in 1 month, or we can say they happen over the span of a few months. In this sample, what we're going to do is we're going to allocate the budget over a few month period, and we're going to use a method called straight lining. Straight lining is just another way of saying allocating the costs evenly over the number of periods they're incurred. So for instance, acquisition, we're going to spend $6 million on this acquisition line item. If we say the costs are going to start in month 0 and they're going to end in month 0, that means they're all going to happen in that first month 0 being today, which means 6 million are going to happen in month 0. But if they're going to start in month 0 and end in month 1, for instance, now they're happening over a 2-month period. So we're taking that $6 million and allocating it evenly between 2 months so that we can more accurately track when we're going to be deploying this capital. If it ends in month 8, it'll be tracked over a 9-month period, right? Month 0 is just today, and then month 1 is at the end of that first month, month 2 at the end of the second month. So we're saying this is going to be at the end of the 8th month. Now you'll see we're allocating that $6 million over this 9-month period. And the reason we do this, and the reason we go into such detail in doing this, is because it helps us not only understand when we need to raise equity from ourselves as an operator, as a GP, from our partners as an LP or limited partner, but also it helps us understand when we need to go to the banks and get a loan. And we will cover that in more detail in the capital stack tab. The project cost, in essence, is the cost of building a project. And once we complete the project costs, and once all of the costs are finished, you'll notice in this section, our last cost is going to happen in month 16. The project is going to be complete. Now, typically, there's going to be a period between completing the construction and leasing out all of the units until the building is stabilized. And stabilization just means that all of the units available for lease are leased. There's typically going to be a gap between completion and stabilization. But in this example, we're just assuming that once the building is complete, all of the units are going to be occupied. So you'll notice the building's complete in month 16. So starting in month 16, we're going to be occupying units, meaning that the units are going to start generating revenue. They're going to start generating revenue in the form of the operating statement. So if we go to this operating statement tab, what we'll review is untrended figures, meaning the rents if they're not growing. We'll review trended figures, meaning rents and expenses if they are growing. And then we'll review a sample commercial rent roll and what that means. And finally, we'll briefly talk on recoveries and what that means. We don't have recoveries in this example, though. So to start, this is the multifamily rent roll. Up top, this is the multifamily operating expense down below. And then we can choose every year at what rate the revenues and at what rate the expenses are growing. So to start, you'll see we're saying that the total project has 200 units available. 40 of those units are studio bedrooms. 100 of those units are 1-bedroom apartments, and 60 of those units are 2-bedroom apartments. We can say that there are actually 100 2-bedroom apartments, and you'll notice how all of this information will update accordingly. So we're going to back out of that for a second, but that's part of what's unique and helpful with a dynamic model. Once you plug information into a blue cell, everything else updates automatically. You don't have to worry about crossing your T's and dotting your I's and updating other things in other areas, because if a model is dynamic and built accordingly, updating one cell in one area will ripple throughout the rest of the model. So we'll have a unit count here, and it'll show you what percent of the building is made up of these different units. Then what we'll do here is just showcase the average size of each unit mix, and this will give us a weighted average. And then we'll have today's dollar. So before we even start building the project, we're saying that the studios would go for $2,200 a unit a month. The 1-bedrooms will go for $2,400 a unit a month, and the 2-bedrooms will go for $2,900 a unit a month. And next we'll go to the multifamily operating expense section. So when you're operating a project on a monthly basis or an annual basis, as an operator, you're going to have expenses that are going to be incurred. You're going to have to pay for utilities, insurance. There's going to be repairs and maintenance that you're going to have to pay when tenants move out of their units, or if things break while tenants are living in their units or in the common areas. You're going to have to pay for the building's trash to be disposed. You might have staff that helps you maintain the building that you're going to have to pay. There are real estate property taxes that you'll have to pay every year. And then finally, there'll be some general and administrative expenses. You need to figure out, analyze, and understand what these expenses could look like. In this example, we're just saying that each line item is going to have monthly expenses, but you can see how these monthly expenses correlate to monthly expenses per unit or annually as they relate to a unit, and then at a project in general, what the annual expenses look like. And what we're going to do is we're going to grow these expenses and we're going to grow these revenues because of inflation. Things change and mostly things trend upwards over time. So because of that, we're going to say that we're growing revenues by a certain percentage and we're growing expenses by a certain percentage every year. In this next section, we're going to be covering the multifamily operating cash flows. So you'll see we've separated out into rental income and operating expenses. And what you'll notice is that the revenues and expenses are both coming in online once the project is complete, and then they're growing from there over a 10-year period. Now, if we made the revenue and expense growth rate 0, you'll see in year 3, they're stagnant across the board. But why aren't they stagnant in year 2? Well, because if we go to the project cost section, you'll see we're ending construction in the middle of year 2. So if we ended construction, and that means that the units are coming online in the middle of a year, so we're not collecting a full year's revenue and we're not incurring a full year's expense. So if we finish construction in month 24 and revisit the operating statement, now you'll see nothing is online in year 2, and we're starting afresh in year 3 in month 25 and trending accordingly. We're not trending is growing because we have 0% growth for revenues and expenses. But if we had 3%, you'll see it then is growing annually. Now, the next piece we'll go to is the sample commercial rent roll. We put this in here just to give you a sense of how a rent roll for a commercial property, commercial, anything with a longer term lease, think retail, industrial, office, we'll set this up typically different than how we'll set up a multifamily rent roll. Because you'll notice each line item will be its own tenant. And with each tenant, they're going to occupy different square footage in their respective space. And different tenants will have different lease terms. It's not going to be yearly. It could be a 6-year term, a 10-year term, a 3-year term. They're going to have different lease start dates. The amount they're paying on a per square foot basis, either a year or a month, is going to differ. The rent escalations will differ. So when we are elevating their rent, typically we're just assuming on multifamily that it's going to increase on an annual basis across the board. But in a lease agreement with a specific tenant, they might have different terms. They might say their rent is escalating 6% every year, or it's not escalating for the first 3 years and it's escalating 3% per year thereafter. And then finally, we have recoveries. So a lot of tenants, when you deal with retail, will be triple net, which means that the tenant is paying all of their expenses. You're getting all of the expenses that you're incurring reimbursed at a property level. Similarly, in multifamily, and we mentioned this before with recoveries, sometimes the tenant will pay some of the expenses. So you might get some of the utilities charges expensed. You might get the water expensed, and trash could be expensed to the tenant. There are a number of things that could be expensed to the tenant, but that's not always the case. So that's the operating statement section. The next section we're going to tackle is the capital stack section. So we're going to dive a little further into the details of the capital stack and what that means. With the capital stack, typically we're breaking out the costs and where those costs are not only going to in terms of uses, the uses are the project costs, and that will correspond directly with the land acquisition cost, the soft cost, the hard cost, any place we're spending our money, those are the costs, and those are what we're calling uses. And for every cost, for every use, we're going to have a source. So every time we spend a dollar, that dollar is going to have to come from somewhere. Where it comes from is called a source. And those sources are broken out into debt and equity. Now, we won't dive too far into the debt side, but you can see we separate the equity and the debt into prospective different tranches. So we talked about the GP and the LP. There could also be preferred equity. In terms of debt, there could be an A note, there could be a B note. That would make up the whole loan. There could be a mezzanine note, or mezz debt as it's called. There are a number of ways you can build out your capital stack. But for this example, we're just going to talk about debt and equity, and then we're going to take equity and break that out further into GP equity and LP equity. So if we go back to this chart over here, we're saying that based off of the example in project costs, we have $50.4 million worth of project costs. If we go back to the capital stack, you'll see total project cost is $50.4 million. So we want to say right now, 50% of the project cost will be funded with debt and 50% will be funded with equity. That means that about 25.2 will be from debt, 25.2 with equity. If we say 70% will be funded with debt, notice how that doesn't just change the amount of equity brought forth from the sources table and the amount of debt, but it also changes the amount of equity from a GP perspective and an LP perspective on the tranches segment. So once we figure out what percent of the project will be funded with debt versus equity, and again, you can continuously update this and see how that impacts the sources. Again, let's just make this 70% debt, 30% equity. Next, we'll have the equity tranches. So within that equity segment, so within this piece, that's made up of GP and LP. GP being the general partner or the operator, LP being the limited partner or the silent partner. Back to our key players section on the CRE overview tab. So the GP equity and the LP equity could also be split 50-50. It could be split 10% to the GP, 90% to the LP. It could be split 20% to the GP, 80% to the LP. But you'll see this split has no bearing on how much debt is brought to the table. It only has an impact on who's bringing what percentage of the equity to the project. So what we're going to do is we're going to look at the monthly uses. Again, the uses correspond to the project cost. We've calculated the uses initially on this project cost section monthly. And if you recall, we calculated on the operating statement annual operations. So we want to take the uses as they happened on a monthly level. We want to figure out their corresponding sources, so equity and debt, on a monthly level. And then once we do that, we're going to break it out into an annual level for sources. So let's go back to that 30-70 split equity debt. Because this is a construction loan, and because based off of risk return profiles, the lender is going to want to make sure that the investors have their money invested into the project before the lender is willing to put any debt into the project. You'll notice the costs are first being drawn down from the equities perspective. You'll notice we don't have any dollars flowing in from a lender's perspective until we've deployed 30% of the total $50 million, which again is going to be that $15.1 million at that equity perspective. And then once we have all of that equity deployed, then we start drawing down from the debt. So then the lender is going to fill in the rest of the capital stack until we draw down all of the debt and we have dollar for dollar project cost to capital stack, sources, which is the capital stack, to uses, which is the project cost. And when we figure out the total equity underneath, that's where we're calculating what percentage of the equity is being filled by the GP versus the LP. We're just assuming that, again, if it's a 50-50 split for every dollar that the equity needs to bring to the table, that's going to be split 50 cents to the GP, 50 cents to the LP. That's called pari passu, means 1 for 1 essentially. And if it's a 20% GP, 80% LP, you'll see that 80 cents on the dollar for the equity is being split for the LP, 20 cents on the dollar for the GP equity is coming in for the GP. And at whole, the GP is making up 6% of the capital stack, and the LP is making up 24% of the capital stack, which 24 plus 6 is 30. There's your total equity. The remaining balance is 70%. That gives you the 100% of the total capital. And as I mentioned before, we're just transponding the monthlies to annual so that when we analyze the deal at full, showcase everything on an annual level, not just a monthly level. So before we go to the next section, we just have some additional debt advantages and debt disadvantages. You don't need to have debt on a project, but when you have debt, that allows your dollar to be stretched further because the cost of the project isn't changing. You still need to cover all of the costs, but now you're borrowing money and you're not using your dollar to cover those costs. You're using someone else's dollar. And the idea of risk reward, the more risk you take, the more reward you hope to receive. The less risk you take, the less reward you hope to receive. So when a lender is giving you money, if you recall, you're first investing your dollars in to the project, and only after your dollars are invested in and you're at a certain point of the project will the lender then give their dollars. And they already have some reassurance that the project is underway, things are going according to plan, and they're going to give you their loan. They're going to expect some return back, and ultimately they expect repayment for their investment before you as the equity receive repayment for your investment. And because they are the last dollars in and the first dollars out, they are taking less risk and setting themselves up for less reward. And in the similar vein for the lender, we're going to talk about debt service. So in terms of debt service, we're going to talk about interest and debt repayment in terms of modeling these dynamic models. Now, this is more simplistic. We're actually saying that we're not going to incur any interest until the project's up and running. A lot of times, once the project is up and running, you'll not only have to pay interest, but you'll have to pay principal. That'll be considered an amortized loan. So every month you'll be making your debt service payment. Part of that will be paying the interest to the lender. Part of that will be paying the principal off that the lender has given you, so that at the end of a fully amortized loan, typically if you're buying a home, single family, it'll be a 30-year fixed loan, fully amortized. And typically at the end of that 30-year period, if you've made your monthly interest payments, there's no debt payoff needed. You're not paying off any principal at the end of that payment because every month a piece went to interest and a piece went to pay down principal. And in this scenario, we're only paying off interest. So we, at the end of the payoff period, we will be paying down the full loan amount that we borrowed. And that'll be here, 35.3 million. Again, if we go back to the capital stack, you'll see we are borrowing 35.3 million. So now we're going to go to the debt service section. This is just showing you that the interest rate is coming in. It's an interest rate on the total amount borrowed from the periods prior. So you'll notice we're taking that 5% of everything that's happened in year 0 through year 2, if we're calculating year 3. If we're calculating year 2, you only have to pay interest for the prior year in this example because you could have incurred all of these costs at the end of year 2, which means you've borrowed money at the end of year 2. You need to have had that money outstanding for a full year in order to pay interest. So when it's calculated on a monthly level, it is much more accurate, but this is just for illustrative purposes. And you'll notice as well, at the end of the hold period, you're going to pay off the total principal balance back to the lender because you borrowed the money, you've been making those interest payments, you've now sold the property, and with the proceeds you've received from the sale, again, you need to first pay off the lender for the amount they lend you before you take the remaining balance and pay yourself off as the GP and your partners as the LP, and then anything left over will be your profit. So let's go to that sale value. In terms of sale value, what we can do is we can decide what year we're selling. You'll notice right now we're selling in year 8, but if we sell in year 5, rather than receiving 72 million in sale price, we'd receive 66 million in sale price. Why is that? Because you'll notice the longer we hold the asset, the more NOI we are collecting annually. Why is that? Because again, everything's tied together. If we go back to the operating statement, we're growing revenues at 3%. If we weren't growing revenues and we weren't growing expenses, and we go back to the sales section, if we sell in year 5, we're making that same 58.8 as we'd be making if we sold in year 8. So let's change that back to 3%, go back to the sale value, and talk about cap rate. So remember, a higher cap rate anticipates a little higher risk as it relates to the value of the property. And as a result, you have on an annual basis higher monthly NOI as compared to that value of the property, versus a lower cap rate anticipates perceived lower risk of project, which means that the annual NOI being derived at that property level is going to be smaller proportionally to the value of the project. And to show that, again, if we make this a 3 cap, the value increases drastically versus a 10 cap, it decreases drastically. So we'll go back to that 6 cap. And then when you're selling an asset, there are going to be costs associated, whether it's brokerage fees or any other selling fees, which there are a number of. So we can estimate a percentage of your costs at sale so that when you have a net sales proceeds, you're taking into account not just the price of the asset given a NOI that's capped at a certain cap rate, but you're also factoring in those selling costs so that you're not taken by surprise if there are costs tacked on to the sale. And once we figure out what the sales price is and the net sales proceeds, those are really the segments of understanding a dynamic underwrite. The last section is really putting all of that information together. So to start, what we would do is we would take the project costs, we add in the net operating income, we add in any debt service that we have to pay, and ultimately the payoff of the principal amount that the lender has provided us in terms of the loan. And then we add in the net sales proceeds from the sale of the asset. And once we add all of that up, that will give us this levered project return profile. In terms of the unlevered project return profile, it's the same thing, but without the debt. So when we calculate the levered return profile, we're taking into account the amount of debt the lender provided us initially to fund the costs. And then we're also taking into account the interest we're paying the lender, and we're taking into account the principal value at sale of the asset needed to pay the lender back for the loan that they provided us. So because of that, you'll notice that without debt, we're paying in terms of contributions. Again, contributions, dollars out, distributions, dollar in, timing, when does that happen? Contributions, we are paying the full 50.4 million of costs. Again, project cost 50.4, going back to the return metrics, 50.4, because here we're not assuming debt. Now, on the flip side, we're receiving every dollar that the project spits out. And when we sell the asset, because we don't have to pay off the lender, we're receiving the full amount of proceeds from sale. If we go back to sale value, it's showing 74.5 million because we have the sale value of 70.2 million plus the operating statement in year 8 of 4.3 million. So 4.3, why don't we do this here in the side? 4.3 plus the sale value of 70.2 is 74.5. That is the total amount we're receiving, 74.5 in year 8. So we are taking everything from a project level. Now, when we have debt, we are only spending the amount needed from an equity perspective. And again, it's that first $15.1 million. If we go back to the capital stack, remember here, it's the first $15.1 million, all spent in year 1 from months 0 to month 8. And then similarly, we're only receiving on an annual level the amount of NOI less the amount of interest we're paying to the lender, which is why we're not receiving 4.2 million. We're receiving 2.4 million because interest is the delta between those two numbers. And then finally, in year 8, we have to calculate the fact that we're paying back the lender, in this scenario, 35.3 million, which is the same amount that we borrowed from them, 35.3 million. And that is the difference between unlevered returns and levered returns. And when you compare the two, you'll notice we are profiting more on an unlevered basis than we are a levered basis, because we are putting more money out in scenario 1 unlevered than we are in scenario 2 levered. Hence, we're receiving more unlevered than we are levered in terms of dollar for dollar. But if we were calculating the total amount we're receiving as it relates to the total amount we're giving proportionally, that would be the equity multiple. If we took all of the net distributions, added them up, and divided them by the total net contributions, remember what we're spending, we're saying that for every $1.8 we receive, we spent $1 to get there of our own money. And if you look at it from a levered basis, from every $2.8 we're receiving, we spent $1 of our own money. And that is leverage. It allows us to stretch our dollar further. Similarly, in terms of the time value of money, IRR, the annualized rate of return, we are spending less of our own money and getting less of the total profits that the project is spitting out. But the ratio of amount that we are bringing in compared to what we have put out is higher when it's levered versus unlevered. And as a result, we have a higher IRR. So typically, at an unlevered level, your profit will be higher, but your IRR and your equity multiple will be lower compared to the levered project returns, where your profit will be lower, but your IRR and your equity multiple is higher. And essentially, comparing apples to apples, what we're saying is in the levered project level, we have $15 million of our equity. And in the unlevered level, we have $50 million of our equity. So if we were to take this $50 million and divide it by 15, essentially what we can say is we are able to invest in 3 of these types of projects if we take debt out. Because if we're only using $15 million compared to $50 million, 15.1 times 3.33 is going to give us that $50.4 million of project cost. So if we're saying we can invest in 3 levered projects, 3 projects with debt compared to 1 project without debt, assuming all things equal and we're making the same amount of profit per project, we can then say if we invest 3 of these projects, 3.33 of these projects, our total profit across those 3.33 projects will be 105 million versus that 44 million. So essentially, comparing apples to apples, we're saying if we wanted to bring $50.4 million of equity, we could invest in 3 projects that look identical and take debt out on these projects and profit 31 million on each of those 3.3 projects to give us a combined amount of $105 million of profit. So that's why groups will take debt out, because it allows them to do more with their equity. So we also have a couple of additional return metrics. We've spoken about IRR, we've spoken about equity multiple. Now we'll talk about some other metrics. Let's talk about cash on cash. For cash on cash, I want to go back to the dynamic model overview, because what we can do is we can see formulaically where these numbers are coming from. So for cash on cash, what we're doing is we're taking the net operating income, we're taking out the debt service, so the interest in a given period, and essentially that's giving us what our distribution on an annual level is, and we're dividing that by the amount of equity we have in the project. So that's saying that we are making 13% cash return compared to our equity investment in year 3. In year 4, we're saying from the cash that we're receiving in year 4, that's, let's round that up to 14% of the amount of equity that we invested in this project. And you can see how that's growing over time. So that's another return metric, cash on cash. The next return metric is yield on cost. Essentially, this is showing us what the net operating income is. So that's not taking into account any debt. It's just the net operating income compared to the total project costs. And that's saying, what is the project generating from an NOI basis related to the amount it costs to build? And you'll see this too grows over time. But where cash on cash is taking into account the equity that's deployed, the yield on cost takes into account the total cost of the project. Then we have a couple of lender metrics. One is debt service coverage ratio. Essentially, this is showing us how many times over does the NOI cover the amount owed to the lender in a period. So the higher the debt service coverage ratio, or the DSCR, the safer the lender feels, because if we have a 2x DSCR, that means we are generating 2 times the NOI than the lender needs to cover their monthly debt service, or the amount that we need to pay to the lender. Now, if it's a one-time DSCR, that means every dollar that we're generating from the NOI, from the project level, needs to be paid to the lender. And if they see that, a question mark is going to go off in their head, because they're going to say to themselves, well, what if there's a bad month? We don't have wiggle room. If they can't generate a net operating income in excess of what they owe us, they're going to have to come out of pocket to pay our fee. And if they can't come out of pocket to pay our fee, we're not going to get paid. And the lender wants to get paid their interest every period. So that is one metric, DSCR. A lot of times lenders will say that they have a minimum debt service coverage ratio requirement. And that could be, depending on the lender, 1.2 times DSCR. So the NOI needs to cover the debt service by 1.2 times. Sometimes it could be more, sometimes it could be less. And then finally, we have debt yield. And for debt yield, what we're doing is we're saying what percentage is the NOI in a given period as it relates to the total amount of debt you've borrowed. And again, if we are to consolidate this tab, project costs, operating statement, capital stack, debt service, sale value, return metrics, we just covered all of this. And if we look at it in full, again, it looks daunting, but peeling back the layers, we just did everything and it was very straightforward. So let's revisit the return metrics tab for a second, because we haven't yet gotten to the partnership metrics. So on the partnership metrics, remember GP-LP returns we want to solve for. We're going to do so right now. And there are a number of ways that distributions can be handled for different partners. What we're going to do here is walk you through the concept of a promote. You might have heard the phrase. We're going to make it very straightforward so that you really understand the fundamentals behind what the promote structure is. There could be different tiers, different levels, different hurdles that need to be hit. But for this example, what we're going to say is based off of the capital stack here, where the GP is bringing 20% of the equity and the LP is bringing the remaining balance, what's going to happen is each party is going to receive their initial principal investment back. So the GP is going to receive their 20%. The LP is going to receive their 80%. That's going to be tier one, or the return of capital. Once the GP and the LP receive their initial investment, their return of capital, any dollar that comes in excess, we're going to say the GP is going to receive a promote on that dollar. And in this case, we're going to say it's a 20% promote. Essentially, what that means is that once the GP and the LP receive their initial principal, they receive their return of capital back, every dollar of profit is first, we're going to siphon off 20 cents and give it directly to the GP. So the GP is going to make 20 cents on every dollar that comes in after the GP and LP have already received their principal amount. So with the GP making 20 cents of every dollar of profit, we now have 80 cents remaining that needs to be distributed to the GP and the LP. And that 80 cents that needs to be distributed will be distributed 20% to the GP and 80% to the LP. Why? Because if we go back to the capital stack, the GP made 20% of the equity investment and the LP made 80% of the equity investment. So that after the 20% promote is siphoned straight to the GP, the remaining 80% will be then split again, 20% to the GP, 80% to the LP. And if we go back to the return metrics, you'll see we cover that in terms of distribution. We'll say 20%, that D46 cell, is freely flowing to the GP, plus 1 minus 20%, or 80% of the remaining balance of that dollar profit, needs to be multiplied by the GP share, 20%, and that is going to be 16%, I believe. And 16% plus 20% is 36%. And that's how we're calculating what needs to be distributed for every dollar that comes in as a profit after the GP and LP receive their principal amount back. And that is the fundamental understanding of what a promote means. So with that, we're calculating it down below. You'll see up top, we have the contributions, the GP coming in with 20% of the equity, the LP coming in with 80% of the equity, and then we have the distributions. We're saying that every dollar that comes in until the GP receives 3 million and the LP receives 12 million is going to be split 20% to the GP, 80% to the LP. And you can see that here, right? In year 3, this is 20%, this is 80%, and it keeps splitting until year 8. And in year 8, this is when we're selling the asset, we're finally hitting the return of capital for the GP and the LP. So then we go to that next tier. And that next tier, we're showing all remaining proceeds are split 36% to the GP, that would be 12 million, and 64% to the LP, that would be 21 million. So we have the remaining balance after tier 1 is 33 million. This needs to be split 36% to the GP, 64% to the LP. We do so here. Now it's all distributed. And when we sum everything up, the total amount that we've distributed is that 48.55 million number, which is up here, 48.55, the total levered distributable cash. And then when we calculate it for the GP and LP's return profile, we have the contributions from a GP level, the contributions from the LP level, which we know 3 million GP, 12 million LP, right? 3 million GP, 12 million LP. And the distributions, 15 million to the GP, 33 million to the LP. So the GP is profiting 12 million and the LP is profiting 21 million. And similarly to the concept of unlevered and levered, right? Unlevered no debt, levered debt, how you're profiting more unlevered, but you're stretching your dollar further with levered. It's the same concept with the GP and LP. Because the GP was the operator, presumably they did all the work. They received the promote. So they got 20% of the profit before the remaining distributions were made between the GP and the LP. You'll notice that even though the GP profited less than the LP, the GP put in significantly less equity than the LP and received a higher IRR, internal rate of return, than did the LP. And you'll see the GP received 26% IRR versus the LP 17% IRR. And the GP received almost a 5x multiple on their investment versus the LP, who received a 2.7x multiple. Now, if you relate this back to the project level return, the total IRR was 17%, and the total equity multiple was, let's say, 2.9%. 2.9 is more than what the LP received, but less than what the GP received. 17.9% IRR is more than what the LP received, but incrementally more, and less than what the GP received by a pretty significant amount, because that property amount is then distributed between the GP and the LP. And that's why the GP is going to make more, the LP is going to make less, but because the GP put in significantly less equity, there's going to be a larger reaction to the GP's IRR and equity multiple than there will be a smaller reaction to the LP's IRR and equity multiple, because they put in significantly more equity. So the change is less than it is at the GP level. And then finally, what we've done is we've taken everything we've just reviewed: project cost, operating statement, capital stack, debt service, sale value, return metrics, all of the makings of this dynamic model overview, and all of these inputs are flowing from the other tabs, right? There are no inputs on this tab. Everything flows from the following tabs, these blue cells. What we've done on this dynamic model template is we put all of the inputs on this template itself so that you can go through and play around with the inputs and see for yourself how different inputs impact different return metrics, how they impact the flow of capital, right? For instance, if we make this promote 50%, there's no change to the project level returns unlevered, no debt, levered debt, but there is a change to the GP and LP returns. And you can play around with it to try to get a better understanding of how different variables impact different outputs as it relates to a project. And that really concludes our educational video walkthrough. We try to make it as simple as possible by compartmentalizing the fundamentals of real estate underwriting and analysis into 6 coherent structures. And these are the topics that we reviewed. In the summary tab, you'll see topics we reviewed. We have some next steps. We're also putting out another video and a corresponding Excel document where we'll cover additional Excel tips and tricks. We have a glossary of terms which we'll provide. They're actually hyperlinked down below. We will put together a sample modeling test, and you can find all of those attachments and links right here. If you want to visit our website and learn more about us, you can click this link here. And then finally, really would appreciate any feedback that you have. We're constantly trying to make this better so that individuals can learn more efficiently. We know we have a lot to improve on, and to the extent that you can help us get there, we'd really appreciate that. So with that, I really appreciate you spending the time to learn about real estate underwriting and analysis. Again, my name is Spencer Correnti, and if you have any questions, please feel free to reach out. Thanks again, and hope you have a great rest of your day.